All right, diving right in, folks. Welcome to our deep dive on, deep dives, specifically market cycles. Got Howard Marks' book here, Mastering the Market Cycle, ready to unpack it all.
Yeah, should be interesting.
Even Warren Buffett, the Warren Buffett says he learns something every time he reads Marx's memos.
That's high praise.
So we're talking about understanding how these cycles work, what makes them tick, ultimately helping you, dear listener, make those smarter investment moves.
Sounds like a plan.
See, the thing about markets is they're not some perfectly predictable machine, running like clockwork.
Right.
It's all about human emotion, isn't it? You got your exuberance, your fear,
Yeah.
optimism battling pessimism.
Yeah, it's that constant swing back and forth that creates these cycles Marx talks about. That's what we're going to explore.
Exactly.
It's kind of like a pendulum swinging.
Oh, interesting analogy.
It goes to extremes, right? You see those peaks and valleys in the short term, but it's the long-term trend line that really matters. That's the direction we got to focus on.
That's a great way to put it. Long-term vision. Now, Marx himself, he admits he's not an economist.
Oh, really?
Yeah, approaches it all from, a common sense angle, practical experience.
Makes sense. He dives into things like, GDP, for example, gross domestic product, a country's economic output, all those goods and services produced.
Right. So we're talking big picture here.
Yeah, but you'd think maybe there'd be steady growth, right? Predictable. But it's not always like that.
Actually, he brings up a fascinating point in the book. The U.S. economy, it rarely sees GDP growth between, say, 8 and 12%.
Interesting.
It's almost always above or below that range. So the question is why? What's really pushing these swings?
Well, it shows, again, that markets, even the whole economy, they're not always purely rational.
Right.
It's the mood, investor sentiment that plays a huge role. Like those swings outside that normal GDP range, what's behind them? Often just human behavior, like we see in those broader market cycles.
Marx actually has this really clever analogy. Imagine an empty building, right? Pessimism is high. Investors see a useless asset, a drain.
Yeah.
But then optimism picks up. Suddenly that same building, potential gold mine, full of future tenants, cash flow.
Perception is everything.
Exactly. Same building, totally different valuation. All depends on the mood of the market.
And that ties into risk tolerance.
Yeah.
When optimism is high, risk aversion, it plummets. People take bigger gambles, demanding less return for it, and boom, asset prices go up. Sometimes way too high.
Yeah, we saw that play out leading up to the 2008 crisis. Marx talks about that period. Extreme risk tolerance, almost reckless the decisions being made.
Scary stuff.
Big time.
Which brings us to, the credit cycle. Really important part of this all. When credit gets tight, fear spreads, capital dries up, lenders have the power, right? They demand higher returns, tougher loan terms.
So opportunities pop up there for those who are ready.
Oh, absolutely. You got to understand the dynamics at play.
Marx actually, he and his partner, Bruce Karsh, went through this back in 1990. Market for sub-investment grade debt, the junk debt, it collapsed. Gave them a front row seat to the whole distressed debt world, where opportunities can come out of, overly optimistic lending, basically.
So distressed debt. It's when you have, first, that loose credit during good times, fuels risky ventures.
All right, everyone's feeling good.
Then, bang,
Yeah.
something bad happens. Those excesses are exposed.
Yeah.
Financial distress. And that's where savvy investors can step in.
Like a treasure hunt through the wreckage.
Kinda, yeah. Marx really emphasizes that combo, unwise lending plus a market shock. That's what creates those unique opportunities.
He also talks about real estate, the cycle there, long lead times, Building a big apartment complex takes forever. So those swings in supply and demand, they get amplified.
Makes sense.
Demand's high, but it takes ages to increase supply. So you end up with overbuilding, price corrections. It's a whole thing.
And this all ties into a big point Marx makes. That danger of thinking it's different this time, especially when markets are at extremes.
Oh, yeah, we've all heard that one before.
But human behavior, it's the constant driver, right? Circumstances might seem unique, but those underlying patterns, they repeat because of those emotional forces.
Like the Nifty 50 stocks back in the 60s, considered blue chip can't miss companies.
But even they got caught up in the market's game.
Why do you
Investors, they were so excited, bid those valuations way up, believing these companies were, invincible, immune to downturn.
Hi.
They weren't.
Yeah, tough lesson there. Even for America's best companies, No one's immune to those market forces.
It really drives home that point, doesn't it? It's different this time. We hear that so often.
All the time, and it usually ends badly.
Think about the dot-com bubble, late 90s.
Oh, yeah. Textbook example. Companies with barely any earnings, some with zero revenue going public. Stock prices through the roof.
Crazy times. People just got swept up in the whole internet frenzy,
Hmm.
ignoring all the usual sensible valuation stuff.
So if these cycles are, like, inevitable, how do we avoid getting caught up in the hype? Or, on the flip side, paralyzed by fear? How do we navigate this as investors?
Well, instead of trying to, predict the unpredictable, Mark says, focus on understanding where we are in the cycle.
Okay, makes sense.
What's the sentiment like? Is it crazy optimism bordering on reckless? Or is it all doom and gloom, fear driving everything?
He's big on contrarian thinking, right?
Oh, yeah. Going against the crowd. Sounds easy, but it takes guts, especially when everyone else seems to be making a killing.
For sure. So what does that look like in practice? Contrarian thinking.
It's about being skeptical when everyone's euphoric and bold when fear's in control.
Interesting.
Because the market sentiment, all that human emotion stuff, it's often a contrarian indicator. Everyone's super optimistic. Risk is probably high. Pessimism everywhere. Might be some opportunities hiding there.
So let's say, hypothetically, everyone's piling into tech stocks. What would a contrarian investor do? What questions would they be asking?
Well, they'd want to know, why all the excitement? What are the assumptions behind it? Scrutinize those valuations. Are things getting out of hand?
Looking for those red flags.
Exactly. Thinking long term, is this sustainable? Basically, looking for cracks in the story. Reasons to be careful while everyone else is partying.
So it's not just being different for the sake of it. It's about thinking independently.
Yeah, having the guts to break from the herd when your own analysis says, hold on a sec, or to jump in when fear is creating those bargains.
Marx also talks about having a margin of safety, right?
Yeah.
In our investments.
Oh, that's crucial, especially with all the uncertainty. It means buying stuff at a price way lower than what it's truly worth.
A buffer, basically.
Yeah, a cushion. If things go wrong, or even if our analysis is a bit off.
So when fear drives prices down, those contrarian opportunities, that's when we find that margin of safety.
Exactly. Pessimism makes people overreact, push prices below what the fundamentals justify. That's where a patient, disciplined investor can clean up.
But we can't just buy anything that's cheap, right?
Right.
Got to be selective. How do we know if something's truly undervalued, not just temporarily out of favor?
That's where the real work comes in. Got to analyze the company, its financials, how it stacks up against the competition, growth prospects.
Deep dive stuff.
Yep, build up a picture of what it's actually worth. Consider all the factors, not just the numbers.
So more than just bargain hunting, it's understanding true worth.
Exactly. And that means understanding the industry, what's driving it, all that.
We talked about the credit cycle earlier. How does that tie into making smarter investment choices?
Well, credit cycles, they're a huge driver of these market cycles. Credit's easy to get. Businesses borrow, invest, expand, fuse the economy, asset prices go up.
Makes sense.
But then credit tightens up. Opposite happens. Businesses struggle, investment slows down, the economy can shrink, prices drop.
So knowing where we are in that cycle helps us kind of gauge the overall risk level.
Absolutely. Credit's loose. We got to be more cautious, demand higher returns for the risks we're taking.
And when it's tight, those tougher lending standards, they actually create opportunities, right? For those who know how to play that game.
For sure. Lenders get picky. They want higher interest rates, stricter terms. That's where you can find some really attractive investments.
Yeah.
Like in distressed debt.
High risk, high reward kind of stuff.
Exactly. But it takes expertise. You got to know what you're doing.
Sounds like mastering these cycles, it's a constant learning process. Recognizing patterns, managing risk, being contrarian when it makes sense.
And understanding how all these different cycles work together. The economy, credit, specific industries, it's all connected.
Marx is upfront about the fact that even the best investors, they make mistakes. No one's perfect. But there are ways to, minimize those risks, make better decisions.
One big thing is admitting we don't know everything. A bit of humility goes a long way. The market has a way of humbling everyone, eventually.
Keeps you grounded. It's funny, isn't it? Marx really emphasizes the, psychology of investing.
Yeah.
It's not just the numbers, it's understanding how people behave. Our own biases, how those play out in the market.
That's what makes his approach so insightful. He's not giving you a magic formula.
Right.
More like a way to think about markets. Recognizing, hey, we don't know everything.
Right.
Making better decisions, hopefully.
He talks about this cycle of success thing, which is kind of weird when you think about it. Success can actually, lead to failure.
Oh, yeah. He gets into that. It's like when things are going great,
Yeah.
investors get super confident.
Yeah.
Right, maybe too confident. Start taking more risks, get sloppy with their analysis.
To infuse a bull market with, like, actual brilliance.
Exactly. They forget about luck, the fact that, hey, markets go up, ND down. And then what happens? The market turns, of course.
And those who were, riding high, taking those big risks.
They get hit the hardest. Confidence disappears, turns into caution, even fear. They won't touch the market.
So they miss the next upswing because they're too scared.
Yep. It's a vicious cycle almost.
Yeah.
Success, then complacency, then losses, then fear. Miss out on the good times.
So how do we break that cycle, avoid those emotional extremes that can, really mess us up long term?
It's about always learning, I think, and a healthy dose of skepticism.
Question everything.
Pretty much. Question our assumptions, our own biases. Be open to new information, even if it's uncomfortable.
Marx seems to do that well himself. I mean, the guy's incredibly successful, but he's also, really grounded.
Yeah, he's down to earth.
Admits he gets caught up in the emotion of it all, just like the rest of us.
It's refreshing, actually. Makes him more relatable. He's not pretending to be some kind of market oracle.
Right, he's sharing what he's learned, his mistakes even.
Exactly, which is valuable.
So even if we understand these cycles, we're not going to be right all the time, are we? There's no, guaranteed path to always winning.
Nope. Investing, it's a probability game. It's about tilting the odds in your favor, not being perfect.
I like that.
We can improve our process, make better decisions, but there's always going to be some luck involved.
He uses that poker analogy, right?
Yeah, it's a good one. You're not going to win every hand.
Yeah.
It's about playing the hands you're dealt well.
Yeah.
Over time, you come out ahead.
That long-term thinking again. So we can't control the cards we're dealt, the market conditions, the surprises.
But we can control how we play them, manage our risk, react to changes.
So understanding cycles is just one piece of it. It's about combining that with, emotional discipline, patience, that long-term view.
It's understanding that markets are complex.
Yeah.
So many factors at play, including our own psychology. And I think embracing that complexity, keep learning, adapting as we go. It's a journey, not a destination.
Well said. And that wraps up our deep dive into Howard Marks' Mastering the Market Cycle. Hopefully you're leaving with a better grasp on these forces that shape markets and, a clearer sense of what it takes to be a smart, disciplined investor. Keep learning, folks, and as always, happy investing.